life and whole life. So we're going to talk about those, what they are, and we're going to look at some illustrations. Now, before we get into it, I want to talk about some of the benefits to life insurance, and this is, something that means a lot to me as a father, a husband. A lot of these benefits apply directly to me. Number one of the biggest expenses that people have is paying off their mortgage. I mean, people are paying that down 15 years, 20 years, 30 years. I currently have a mortgage, and I can't imagine what it would be like for my wife to, as a single mother, if something were to happen to me, to bear that cost by herself. Not to mention I have 2 children and 2 on the way, so we're expecting twins. So if that doesn't up the stakes. Children with their college expenses, a lot of people like their children to take on that expense themselves. Other times parents like to help their children, but that is a benefit of life insurance. The fact that if my kids one day want to go to college, they have that option. To pay for funeral costs, I know a family that had to dip into their 401k and take a lot of their money out and take a penalty because they didn't have the funds available for that, so life insurance would cover that. Also, any other debt, car loans, credit card debt, life insurance could cover those as well. And it could also create wealth or a retirement for your beneficiary, whoever your loved one is that is the beneficiary on the policy. So those are the benefits of life insurance. And I know that at least some of these, pretty much fit a lot of people's needs today. Now, the first type of life insurance I want to talk about is term life. This is currently what I have. A lot of times people get that because it's the most affordable type of life insurance. Right now I pay less than $30 a month for a very big policy, or $500,000 right now. And so it would cover the mortgage, children's college, and probably a couple years to where my wife, if she chose to get remarried, she could take a couple years and really not have to work. I can't imagine what a single mother would do in that scenario. 4 kids, working, daycare, etc. Another benefit, it's a level premium, so my rate's not going to go up for the next 30 years. I got this policy, I renewed my policy 2 years ago. So I was 26 at the time, so I'll be 56 that this term policy will take me till. And also it's for a specified term length, which is in the name, term insurance. So that's the purpose of term insurance, and that's how that works. The second type that I want to talk about is universal life insurance. Now, this falls under the umbrella of permanent life insurance, but it's kind of a hybrid. It's got a term component, and it's also got a whole life component. Number one, universal life, it's a type of permanent insurance, like I said, but it has a savings component. So built into the price of a universal plan, there's the term cost. You're paying that, but it also has a savings account component, and the purpose of that is to fund the savings account while you're younger. That way, when insurance rates rise as you get older, the cash value from that savings account can pay those higher amounts later. Ultimately, the purpose is to have the cash value to keep your premium payments constant. So you want to pay the exact same rate all throughout your life. When you're younger, you're going to overfund it. That way you can draw off of that. We're going to talk a little bit more about that in just a second. The third type is whole life insurance. It's permanent insurance. The purpose is to, no matter when you die, whether you're 56, 36, 106, the purpose is to have a death benefit available, a guaranteed death benefit. Now, the cost is fixed, and premiums usually don't increase. Now, I bolded that for a reason. We're going to talk about that. They usually don't increase. We're going to look at some case studies. It accumulates cash value, just like a universal life. The cash value can grow, right? It'll increase by the assumed interest rate, whatever it is at that time. It can be borrowed against, or you can withdraw that cash value. And some plans have options for dividends. Now, the great thing about a lot of these policies is they have an option so that if somebody is deemed terminally ill by a doctor, you can actually draw off that death benefit prior to passing away. So that way, if I was terminally ill, deemed by a doctor, I could actually draw off that death benefit to help with maybe the treatments or some of the added costs of the hospital or the doctors. So that's a great benefit. Now I want to look at 2 different illustrations here. This is an actual policy that we reviewed a few weeks ago, and this is the way that life insurance is supposed to work. This is a $10,000 whole life policy, and what you can see here is that this was funded very well. It's a $10,000 life insurance policy. It was funded so well that it's paid up he no longer has to make payments on this policy anymore. It has a cash value of $16,348. So if he wanted to close the policy today, he could take that money. The second thing is, if he passed away today, he would actually receive $18,700, the total of these two, but he would have the amount payable if he passed of $18,700, and he could take that money. I'm sorry, his beneficiary would get that money once he passed. Now, if he doesn't want to touch it, if he wants to let it grow until the age of 90, it's actually going to be worth $32,000. That's 3 times the amount of the $10,000 death benefit that it was in the beginning. And so that's the way these whole life policies are supposed to work. Now, what often happens is a lot of times the policies are underfunded. So look at this next illustration. This is Bob. You don't want to be Bob. Sorry if there's anyone named Bob here. But you don't want to be Bob, because what happens here, see, this is a $50,000 death benefit. So Bob has this plan and he thinks that he's good. But what happens is because it was either, number one, underfunded, or maybe a lot of times what happens is they get these plans 20, 30 years ago when the interest rates were much higher. Now that the interest rates are lower today, what's happened is the cash value didn't grow like they thought it would. And so what happens today, they have a $7,000 cash value, and what's going to happen in 4 to 5 years? It's going to go to nothing. And so he's either going to, one, he can't afford the payments, or he's going to have to try and find a way to make these growing payments. It looks like here, $1,000, $1,200, $1,400, $1,600, $1,800. So the price of this is going up because he's not going to have the cash value to draw off of. Now, one thing that we want to do, if this scenario fits you, there's something called a 1035 exchange. And what that is, it's a provision in the tax code that allows you to take the transfer funds from the policy that you currently have. It might be outdated. Transfer the funds from one policy to another, and you don't have to pay taxes on that income or on that money. The policyholder must be the same person, and it must be an exact replacement. But the purpose of this is to improve the benefits, because a lot of plans are much better today. They have lower fees and they have different investment options. So if you currently have a whole life insurance policy or any type of life insurance policy, what we want to do is something called a needs analysis, and also set an appointment so that we can do an in-service illustration. We want to review the insurance that you currently have, the life insurance, and we want to make sure that you're in the best vehicle possible based on your current financial situation. So that's what we want to do. We would like to set an appointment with you today. Even if a whole life insurance policy doesn't fit your needs where you're currently at, you may know somebody who's younger. Many of you probably have children and maybe grandchildren. You know, maybe you have someone in your life who's my age, 28, just got married, just bought a home. Those are perfect candidates for people who need a term life insurance policy. And I have had many friends, unfortunately, they say, oh, I don't need a life insurance policy right now. They wait a few years, maybe their health declines, and guess what? They can't get that low rate that they had when they were younger and they were in good health. So does anyone